Welcome to the deep dive. So, you're looking into annuities for retirement, and yeah, it can seem pretty complex sometimes.
Definitely. There's a lot of terminology.
Right. So, our mission today is simple: cut through that complexity, use our sources, and give you the core info you need. So you feel well informed about this option.
Sounds good. Let's get started.
Okay, let's dive right in. At its heart, what is an annuity?
Fundamentally, it's a contract. You make a deal with an insurance company.
A contract for what?
You give them money, maybe a lump sum, maybe payments over time, and they promise to pay you back down the road. It creates a future income stream.
Okay, planning for future income. Got it. But the overview mentions different kinds. Fixed, variable, indexed. Can you break those down quickly?
Sure. A fixed annuity is the most straightforward, the guaranteed interest rate, like a CD or savings account.
Yeah.
Very predictable.
Safe and steady. Okay.
Then there's variable. That one's linked to investments, kind of like a 401k. Potential for higher returns.
But also potential losses, right? Market risk.
Exactly. Higher potential reward, higher risk. And indexed annuities try to split the difference.
Oh, so?
They're tied to a market index, say the S&P 500. You get some potential upside linked to the market, but often with downside protection.
Downside protection sounds good. Any catch?
Well, yeah, the potential gains are often capped. You might not get the full market return. It's a trade-off.
Makes sense. Risk versus reward. So why would someone go for an annuity instead of, just sticking money in stocks or bonds directly? What are the main pluses?
The biggest draw for many people is that potential for guaranteed income later on. Knowing you'll have money coming in no matter what the market's doing. That's huge peace of mind.
I can see that. What else?
Well, there's tax deferral. Your earnings grow tax-free until you take the money out.
Like a traditional IRA or 401k?
Right. And many also have a death benefit. If you pass away before getting all your payments, your beneficiaries usually get something.
Okay. Guaranteed income, tax deferral, death benefit. Sounds pretty good, but I always hear about fees. What costs are we talking about?
Ah, yes, fees. You definitely need to watch those. There are often surrender charges if you pull your money out early, sometimes for many years.
Ouch. So not very liquid.
Not typically, no.
Yeah.
Then you have administrative fees just for managing the contract. And for variable annuities specifically, there are mortality and expense risk charges.
What are those for?
They cover the insurance company's guarantees, like the death benefit and their operational costs. Fees can add up, so you need to understand them up front.
Absolutely crucial. So how do annuities fit in with other retirement accounts, like the 401ks or IRAs we mentioned?
Think of 401ks and IRAs as mainly for building your savings, the accumulation phase. Annuities are often more about the payout phase, turning those savings into a reliable income stream.
So they can work together.
Yeah, potentially. You might save in your 401k and then use some of that money to buy an annuity when you retire to guarantee some income.
Interesting. Our sources also highlight something called a lifetime income rider. What's that about?
It's an optional add-on, usually costs extra, but it essentially guarantees payments for your entire life, no matter how long you live.
Even if the original annuity value runs out.
Exactly. It's like insurance against outliving your money, a big selling point for some.
Yeah, that tackles a major retirement fear. So timing. When does buying an annuity generally make the most sense?
Typically, it's something people consider more seriously as they approach or enter retirement, when that need for predictable, guaranteed income becomes more pressing.
If you're worried about outliving savings, maybe.
That's a prime scenario, yes.
And taxation, when you start getting those payments, how does that work?
Generally, the earnings portion, the amount above what you originally put in, is taxed as ordinary income when you withdraw it.
Okay, so tax-deferred, not tax-free. Got it.
Now let's flip the coin. What are the potential downsides or risks?
You touched on some. Surrender charges are a big one if you need cash unexpectedly. For variable annuities, there's clear market risk.
Your value could drop. Yes. Then there's inflation risk. If you have fixed payments, their buying power can erode over decades.
That's a long-term concern. Anything else?
A really important one. The financial stability of the insurance company itself. Your guarantee is only as good as the company backing it.
That's critical. How do you even check that? How do you evaluate a provider?
You look at their financial strength ratings from independent agencies like AM Best, Moody's, S&P. Higher ratings are better.
Like a credit score for insurers?
Sorta, yeah. Also, look at their reputation, how long they've been around. Due diligence is key.
Okay. So wrapping this up, Annuities can provide that guaranteed income, which is appealing, but there are different types, different risks, different fees. It really seems to depend on the individual.
That's exactly right. It's not a one-size-fits-all solution. You have to weigh the pros and cons against your own specific financial goals and your tolerance for risk.
Really understanding your own situation is paramount.
Absolutely. Careful research, maybe even talking to a trusted financial advisor who isn't just trying to sell you one product.
This has definitely cleared things up. So, thinking about all these features, the guarantees, the risks, the costs, here's something to ponder as we finish this deep dive. Considering the diverse types and features, what aspect of creating a reliable retirement income stream is most critical for you to address right now? Thanks for joining us.